Hi everyone, welcome back to Biri's podcast. Recently, I came across an article from the Money Control website, which I thought it will be interesting if we share it in a podcast. So the topic is why loans against mutual funds are gaining in popularity. So how does loan against mutual funds works?
Loan works on two principles. One, you have secured loans, and then you have unsecured loans.
Okay.
Unsecured loans are the ones which are very expensive, which is your personal loan. A personal loan is given on a personal guarantee that you'll pay the loan. That's why they charge you a high interest rate for it, because there's no security. If you don't pay the loan, he can't do anything to you. Right? The other is secured loans. Secured loans are loans where you're giving a collateral. So collateral is what you're using to secure the loan. So anything can be a collateral.
Okay.
Right? You have property. You take a loan against property. You can take a loan against gold. You can take even loan against shares. So why not mutual funds? Mutual funds are, you can take a loan against your LIC policy. You can take a loan against your PF.
Oh.
Right. So mutual fund which is there in your name, the unit has certain value. So based on the mutual fund and the borrower you're borrowing from, you can get anywhere between 50% to value to up to 80%.
Okay.
So let's say it's a blue chip company, like a Reliance share you have. They'll give you more money against that. If it's some unknown small company, they may not give you any money. So same thing is true in mutual funds. So depending on the mutual funds, the amount of units you have and the company, mutual fund company you're with, the loan will be aggregated and valued on that, and they'll give you a loan. And of course, the purpose of the loan, in something like a car loan, you can only take the loan to buy a car.
Yeah.
House loan, you can only take the loan to buy a house. But on this kind of a loan, the purpose is up to you. So you can take the loan and use it for business.
Okay.
You can use it for any pleasure you want, or you can take it and reinvest it in something else. So it's up to you. The purpose of the loan, they do not curtail you. So this loan to value a loan depends on each lender and whatever they feel like giving you.
Okay.
Interest rates will be always lower compared to a personal loan which is unsecured. But compared to a home loan, it will be more expensive. But it's a very common thing and it's very easy to do. Though I advise you not to do it, because you should not take a loan, especially in these markets. Because let's say a mutual fund unit is valued at 100 rupees,
Okay.
right? And they're giving you 50%. This happens with shares. That's why I'm saying don't do it. Like today, the market corrected, right?
Yeah.
So let's say your mutual fund units one day suddenly corrects like that. So what will happen is that 100 rupees now is valued, let's say, 70 rupees.
Okay.
That means you can only borrow 50% of that. So your 50 rupees borrowing has to come down to 35 rupees.
Yeah.
So immediately he'll tell you to pay that margin. The difference he'll ask you to immediately pay. If you're unable to pay it, he'll immediately say, I have to sell some of your units.
Okay. They'll do that by themselves.
They can do whatever they want.
Okay.
And they can claim it. One lady, this happened to her, then she went to court. And she fought in court, and then the court said, no, you were wrong in doing it without her permission when she was ready to close it and give back her money and all that happened. That's the amount of power they have when they're holding your units. They can decide to liquidate it. If they think you're not trustworthy, they can liquidate it.
Okay.
So be careful. When you borrow, you're giving your security. And they can sell it very easily, like how you can sell it and buy shares.
Okay.
They can sell and buy your units because you have signed it over to them.
So it is similar to gold loans.
Yes, but gold loan, the interest rate is much lower, and they allow bullet payments in gold loans. So it's done in NBFC. So what bullet payment means, let's say the gold loan is due today. So what they'll allow you to do is close the loan today and borrow it again tomorrow. Some NBFCs allow you to do that. So you roll it over. It's called rolling over the loan. So when you make full payment today, and he'll allow you to borrow again tomorrow. So let's say you're not able to pay that loan today and close the loan. So I'll go borrow that money from you as my friend. Do this and flip that and get the money back and give it back to you.
Okay.
So for poor people, there's a way to manage these things. So it's different. Mutual fund and share borrowing is usually done by guys who have money. And most of the people who do this kind of against mutual funds, it is again to do in share market, some trading they're doing.
Yeah.
So my advice is strongly not to do it. And most of these brokers will also offer it.
Okay.
When you're sitting in a Demat account, they'll say it's going to waste, why don't you use it?
Yeah.
And you say I don't have money to trade. You say you can use your mutual fund units. We can give you some money against that, and then you can trade.
Okay.
They'll try to convince you of all that nonsense. Don't follow that. Rule number 1: don't borrow.
Okay. And last question is it the same for active funds, passive funds, and large companies, small companies? How does
Like
it?
I said, it's a security. So he'll charge differently. For
Okay.
active fund, passive fund, any fund, he'll charge differently. How much he's charging depends from company to company and depends on you and your credibility and the companies which are there in the fund.
Okay. So I hope that this video was informative and interesting and you had some knowledge about how the loan against mutual fund works. If you found this video informative, please share it with your friends and subscribe to this channel for more kind of videos. See you in another episode with an interesting topic. Thanks for watching the video.
Thank you.